Okay, gonna do a quick video today on how to understand APR in relation to the starting point of an interest rate. I think this is a important but not fundamental thing to look at. I think you should understand what the APR is, but then I think you should also understand total cost of financing alongside of APR. But APR is an important starting point to getting the understanding of total cost of financing. So from that standpoint, APR is the second interest rate that exists in mortgages. Typically, APR is the only rate in other categories of financing, right? And what I mean by that is if you're a first-time home buyer and you've bought a car before, or you've had student loan, or you have credit card, most of the interest rate conversation is your APR, right? So your credit card will say, hey, your APR is blank, right? It's probably a pretty big number, but you're used to seeing APR as the cause and effect of your interest. In mortgages, it's slightly different. You have an interest rate, which is your note rate, which is going to cause your principal and interest payment over your term, right? So if you have a 30-year mortgage and your note rate is 6.5%, what that means is if your loan amount is 400,000 and you have 30 years and it's 6.5%, that's the yearly rate that's going to determine what your principal and interest payment is based on eventually paying off that loan in 30 years because you're going to end up paying a lot more than 6.5% of that loan amount over the 30 years because it's really just the yearly interest due for the balance that you owe. And then it's like a stepping schedule as you make payments over that time, right? So your note rate causes your principal and interest payment, right? So it ends up being what gets sold the most because that's what impacts your payment. The APR is a representation of the combination of your note rate alongside of other fees and costs associated with buying a house. So we have this over here, quick breakdown. This is one of our ebooks at Churchill Mortgage that I can share as well. But essentially what it is the interest rate you will pay on the home loan. Again, that's that note rate. And then the APR is the interest rate plus the other fees and costs associated with buying the house. Now, what are those fees and costs? Let's keep scrolling down. Again, this is where it breaks down the interest rate compared to the APR. And then the APR, you're going to have most of the things that go into the APR are origination fees, discount points, mortgage insurance, daily interest, some title fees. It's not all closing costs, right? So it's closing costs that they've essentially directly tethered to the cost of financing, right? Now, why is the APR important? The APR can show you how expensive a mortgage is, right? For example, a 30-year fixed mortgage with, let's say, a 6.5% interest rate for a conventional loan, right? With 20% down, so no mortgage insurance, no discount points, and let's say decently favorable closing costs from a lender. You might see your note rate be 6.5, and then your APR might be like 6.6, 6.7, somewhere in that range, because maybe it's including traditional closing costs like underwriting fees, origination charge, but no discount points, no mortgage insurance, nothing, extra kind of piled in there, right? Now, you could look at an FHA loan, which might be like 3.5% down. The down payment's not really as important here. This is the benefit of the APR because the APR can show you total cost of financing outside of what you're like spending for money out of pocket to a degree or another for the down payment, right? So the FHA loan with 3.5% down is going to have mortgage insurance. It's going to have upfront mortgage insurance premium on top of it and the regular closing costs. So maybe there's a no discount point option of an FHA loan with an interest rate of 6%, right? So it looks a lot better than the 6.5 to a degree or another. So if you only looked at the interest rate, you'd say, well, the FHA loan's better because the FHA loan has a 6% rate. But then if you look at the APR on the FHA loan might be higher than the APR on the conventional loan at 20% down because there's no mortgage insurance on the conventional loan at 20% down. There's no upfront mortgage insurance, and then the standard closing costs. So that spread between the offered interest rate that impacts your payment and the APR, the spread is what shows you how expensive the loan is, right? The closer those two are together, shows you that it's not an expensive mortgage from the standpoint of closing costs, right? The rate might be higher than what you want, like a 7% rate with a 7.125 APR. It shows that you're not like paying a lot extra for that rate. You're not paying discount points for it. You're not paying stuff in excess, but it's still a high rate relative to what you maybe want. And sometimes when you run the numbers, you could get a note rate of 6%, be paying discount points, and the APR is much lower. So the APR is kind of a weird, funky thing in the standpoint of it's not really the perfect way to compare loans, right? That's what it was created for, but it's only good in like vacuum scenarios of 20% down, conventional loan, this rate's being offered here. What's the APR? What's the closing cost, right? Because the down payment's stagnant. So it's only good in vacuums. It's decent in comparing like, well, what if I pay points? What if I pay 20% down or 25 or 15 or FHA compared to this? It's really not good for doing a deep dive. Deep dive, you want to just look at everything. You want to itemize out what am I paying in closing costs? What am I paying in down payment? What's my interest rate? What's my interest over the life of the loan? You really want to take the APR from a very glancery perspective and then peel it open, look beyond it. Don't have that be the only thing you look at. I know that's what they kind of tried to create it as in terms of the CFPB to try to say, hey, the APR is going to be this thing that's going to help people, you know, determine what they are paying for with the mortgage. You're way better off just cutting right to like, give me a full breakdown. I don't want to just see interest rate and APR. I want to see interest rate, APR, and then everything. And then let's talk about everything and let's make sure I'm getting the right loan for me. So again, it's going to include most of that. And that's a quick example of what is an APR.